Hello everybody, this is lesson 7 of the lecture International Financial Markets. I will discuss slides 56 to 67 in this lesson. So far we have discussed a couple of key indicators which provide information about the profitability of a stock investment. Another such indicator is the so-called price-earnings ratio. The price-earnings ratio is defined as the market price per stock over the earnings per stock as published by the recent set of accounts. For example, if the profit after tax equals 30 million euro, the number of stock is 10 million and the market price of stock is 60 euro, the price earnings ratio equals 60 euro, the market price of the stock, over the profit after tax over the number of stocks. Profit after tax over the number of stock is called earnings per stock. So in this case, the price-earnings ratio would equal 20. The price-earnings ratio now has two possible interpretations. First one, if retained earnings pay off either in form of future dividend payments or future price gains, the price-earnings ratio is equivalent to the number of years a stock has to be held in order to regain the money invested, if the earnings stay the same in all future periods, of course. So the dimension is then numbers of years we have to wait until we get back our money. The other interpretation is the inverse value of the price-earnings ratio is equivalent to the earnings yield. This means the long-run yield per period that can be expected if the earnings in all future period will be the same as the present earnings. For example, the price-earnings ratio of 20 is equivalent to an earnings yield of 1 over 20, which equals 5%. 5% earnings yield. The all-time average of the Standard & Poor's 500 price-earnings ratio is 17. The red line here. This corresponds to an average earnings yield of 5.9%. As the development of the Standard & Poor's 500 price-earnings ratio shows, the bubble which led to the world economic crisis of the year 1929, this time period here, and the bubble which led to the dot-com crisis of the year 2000, this time period here, had been periods with a very strong growth of the price-earnings ratio. Such an increase is always justified if the future earnings of a stock grow correspondingly. In this case, the price-earnings ratio will decrease again in the long run, since the denominator of the price-earnings ratio, the earnings, get larger. However, the strong decrease of the price-earnings ratio after the years 1929, this movement here, and the year 2000, this movement here, had not been caused by an increase in the earnings per stock, but by the very strong decrease in stock prices following the stock market crash that happened 1929 and in the year 2000. Therefore, very high price earnings ratios are typically interpreted as indicators of the likelihood of a speculative bubble, which might finally lead to a stock market crash. So in simple terms, the price earnings ratio is interpreted as a bubble indicator. This diagram shows that the relatively high price earnings ratios which have emerged since the beginning of the 80s were accompanied by a strong decrease in the long-term interest rate, this dotted red line here. The long-term interest rate is measured here by the 10 years US government bonds, so a relatively riskless investment. We know from the capital asset pricing model that the long-term interest rate is an important component of the discount rate. So one explanation for the increase in the price earnings ratio since the beginning of the 80s might be an increase of the fair value of stock caused not by an increase in earnings but by a decrease in the discount rate. This diagram is based on the same data, the Standard & Poor's 500 stock portfolio. The diagram is taken from the book Irrational Exuberance of the financial market economist Bob Shiller. On the x-axis, we measure the 10 years average backward-looking price-earnings ratio. On the y-axis, we measure the average 20 years forward-looking annualized total stock yield. We have already defined the total stock yield in the last lesson. So we compare in this diagram historical price earnings ratio data with future total stock yield data. I guess it's obvious that this cloud here of dotted observation points shows a clear downward slope, indicating that a low price earnings ratio over a period of 20 years is on average followed by a relatively high yield, and a high price earnings ratio is typically followed in the long run by relatively low yields. For example, a very high price earnings ratio of 30 is typically followed by a relatively low yield, average yield over the following 20 years. While a relatively low price earnings ratio of roughly 5 is typically followed by a relative high positive return here in the interval between 4% and 13%. This indicates that a long-term investor is on average best advised to choose stock with a low price earnings ratio, since a low price earnings ratio leads on average to a higher long run return. This type of stock investor is called value investor. He selects stock that promises the highest long run value. Another interesting question is whether this negative relationship between historical price earnings data and future stock yields is compatible with the so-called efficient market hypothesis of the Chicago economist Eugene Fama. According to the weak form of this efficient market hypothesis, prices on traded assets already reflect always all past publicly available information. So the efficient market hypothesis refers in fact on the efficiency of markets to process information. In other words, on efficient market, prices should contain all market relevant information, which is publicly available at zero costs. Does the data of Bob Shiller's diagram confirm this hypothesis, or does it contradict to the efficient market hypothesis? Well, if investors would take care about the negative correlation between historic price earnings ratios and future stock yields, they would buy stock when the price earnings ratio is low, and they would sell stock when the price earnings ratio is high. This behavior would, however, cause an increase in prices and the price earnings ratio when the price earnings ratio is low, and a decrease in prices and the price earnings ratio when the price earnings ratio is high. So the observation points in this diagram would not be a cloud with a negative slope, what we observe here, but they would lie much more focused around some average value of the price earnings ratio. In other words, investors take not enough notice of the long run systematical negative correlation between historic price earnings ratios and forward yields. So they miss an opportunity to use all information, all available data to increase their investment return. Consequently, the data in this diagram of Bob Shiller contradict the efficient market hypothesis of Eugene Fama. However, Eugene Fama does not accept this interpretation of the data. He has developed a counter-argument which is explained in the following digression on slides 64 to 65. So much for this lecture. In the next lecture, we will discuss forward exchange markets.